So I welcome you all for this workshop on income tax and e-filing. Am I audible to all of you? Yes, am I audible?
Yes, ma'am.
Yes,
Yes,
ma'am.
ma'am. Okay. So basically, in this workshop, I think in the last two lectures, you might have studied about the basics of income tax as well as the residential status. So the topics that I will be covering in this session and in the next session is five heads of income. Okay. So I'll be sharing my screen. Yes. So is my screen visible to all of you? Just let me know if it is visible to all of you.
Yes, ma'am.
Okay. So we will be studying the five heads of income. Let's start this. Okay. So the five heads of okay, what all are the five heads of income? If anybody knows about it. Okay. Never mind, I'll just explain it for you. Basically, there are five heads of income. Okay. There is income from salary, house property, income from other sources, income from capital gains, and income from business or profession. Okay. These are our five heads of income, which comes under Section 14 of the Income Tax Act 1961. Now, there is a question that is posed in front of you, which says, why is classification into different heads of income necessary? Is the tax payable different for each head? So, anybody who knows the answer to this question? See, basically, they say that they are asking you a question. Why is classification into different heads of income necessary? So we have five heads of income, as I told you just before this. So they say that no, there is only one tax on the income which is calculated under various heads, but there are different rules for computation of this income. Therefore, we are dividing it into five heads, and income has to be computed under the head after applying such rules. Okay. Now, these heads of income, according to the chargeability, are given right in front of you. You have income from salary, house property, PGBP as we call it, capital gains, and income from other sources. So there are various chapters to it, sections to it, and even the charging sections that are given. Now, after adding up or making the sum total of all these five heads, we get the gross total income. And after totaling them up, after clubbing all these provisions and making the necessary adjustments of set off and carry forward of losses, we get to our GTI, which is our gross total income. Set off and carry forward, I'll just explain to you, putting the long story short for you. Set off is when you are incurring losses. So maybe you are charging that loss against a different head of income or under the same head of income, some other income. Okay, that is how you set off. And you can also carry forward the loss to the next assessment year. Now coming to the computation of total income of an individual. So we are going to sum total all these five heads of income. We will arrive at our gross total income. And then we are going to subtract certain deductions. Now, why I have written just section 80C and 80U? Because these are the commonly used deductions that are particularly faced by an individual. Okay. 80C is more about your PPF, LIC and all. 80U is more about your medical insurance that you have taken. So you claim it. So all this assessable income, from this, if you subtract your deductions, you get your taxable income. And in whichever tax bracket you lie, according to the old or the new tax regime. So I hope you all have studied Union Budget 2024 relating to taxes. In that, you have two tax regimes, new tax regime and old tax regime. So you can make a choice of new or old tax regime. In old tax regime, what they do is they have given you higher amount of taxes, slab rates, but then also high amount of deductions. But in new tax regime, there are lesser deductions, therefore lesser amount of taxes are available. Now coming to our first head of income, which is income from salary. In this section 15, it says that salary is consisting of these following. As you can see it on your screen, there are three types that are given: normal, advance, and arrears of salary. We'll begin with normal salary. So any salary which is due from an employer, it could be a former employer, means employer who was there previously, to an assessee in the previous year. Whether it is actually paid or not will be taken by default as a normal salary. But if your employer or any salary is paid to you in the previous year by an employer, or even before that, if there was an employer, that is not due, but it became due for you, then in that case, it becomes an advance salary. And in case of arrears of salary, this is when any arrears, like a salary which you have earned earlier, but you didn't get that salary. If you're getting it now, then if it is not charged to income tax for any earlier previous year, then it is going to be taxable in this particular year. Next, we have, there are certain points that we need to keep in mind. One is that once salary is going to be taxed on receipt or due basis, it will not be charged again on falling due or receipt basis. Basically, a salary is going to be taxed just once. This is the meaning of the first line. Second says that an assessee can claim relief under section 89(1) for arrears or advance salary. So they've made a section particularly for any advance salary that you're receiving or any arrears of salary that you are going to get. Another point talks about loan from employer is not salary. Basically, if you're taking an advance salary from your employer, it is not a loan, it is treated as salary. Okay. Next is that partner is not an employee of the firm, and hence any salary, bonus, commission, remuneration which is received, it is not taxable as salary, but it is taxable as business income. There is a reason to it. The reason here is that if you are taking too many benefits from your firm, in that case, all these benefits will come under the head business income. Next section, where salary is going to include a lot many things. There are total points that are given to you on your screen. One is your wages. Then it says annuity or any pension. See, basically annuity is like a continuous stream or regular stream of payments that you are either paying or receiving over a period of time. So any annuity or pension due will also come under this head. Apart from that, any form of gratuity that you are receiving. So gratuity normally you get after you've served at least 5 years of service you've given to your company, then you'll also get gratuity. And that is also going to be form a part, this is going to form a part of your salary. Next is any fees, commission, perks, profits, which come in addition to the salary. This will also form a part of your salary. Advance salary, as I talked in the previous slide. Any leave salary that you are giving means that you're taking quite many leaves and still you are getting paid for it. That is also treated as salary. Next is your annual accretion to the provident fund to the extent it is taxable. So if your employer is paying that, and even if you are paying that, one thing is that for sure that from your salary only there is EPF, Employee Provident Fund, and Employer Provident Fund. So whatever is getting deducted from that, that is also a part of your salary. Next is contribution made by the central government or any other employer to the account of employee under a pension scheme. So there is a certain section that is made. The section name is 80CCD. So in this section particularly, you are going to get a salary income. Now we are going to summate all of this. So we are first adding our salary, 17,1. Then we are going to add all the allowances that you get. Allowances I'm going to cover in the upcoming slide. Any perks that you're getting over and above this, any profits that you're getting in lieu of salary, all of this you're going to total, summate them. And from this, you're going to make a deduction of your entertainment allowance and any tax that you have paid on employment. And if from this, on this tax, I'm talking about the professional tax that we are paying in our employment. Okay. Now this is income under the head salary total. Now we also need to discuss any profits that you're getting in lieu of your salary. So first thing is, let's understand the meaning of the term in lieu. So in lieu, basically it means where employer is going to pay additional amount to the employee. So over and above your salary, anything that you are getting as a part of your salary and which you are also not considering as allowance purposes. If I go back to this slide, there are certain allowances, there are certain perks, and there are certain salaries, but anything that is going beyond this, that is going to be a part of your salary, or we can treat it as profit in lieu of salary, and the amount will become then taxable. Now, there are certain examples that are here. Any compensation you are receiving in termination of employment, for example, you have been employed somewhere, and at that place, you have been working diligently. Now, you're leaving that particular employment, but at the time of leaving your institution or your organization, if you are paid some lump sum, then that is also going to be any compensation that you are receiving. Therefore, it is going to be a profit in lieu of your salary only. Apart from that, you can just go through all these, any insurance policy, amount received before joining. Yes. So I believe a majority of you are going to go for corporates. So when you join any organization, they give you joining bonus. That is also a part of your salary. Now you must be thinking, ma'am, how is that a part of my salary if I've not even started to work? See, the thing is that once you enter the contract of employment, they give you an advance or a gross salary that is known as your bonus, joining bonus. And this is also going to be taxable because this is a profit in lieu of your salary. Then let's come to computation of income from salary. So there is basic salary, then you have your allowances, you're going to add this, you will get the profit in lieu of salary, perks. When you make a summation of all these, you will arrive at gross salary. And from gross salary, you're going to make deduction. Deduction will be standard deduction. So if you all know that in your old tax regime or before this budget, you were getting a deduction of flat 50,000. Now, according to the new tax regime, you are getting a deduction of rupees 75,000. And also you can get entertainment allowance and professional tax. That is also a deduction that you get from this. And finally, you will be able to arrive at your income from salary. Now, if your employer is, now there is an example that is given here, which is to be noted, that if your employer is paying tax on behalf of you, okay, this is the situation that I'm telling you. On behalf of you, your employer has paid some taxes. Then, for when you have to be taxed or when your salary has to be taxed, in that case, what will happen? Your salary that you're actually getting and the tax that your employer is paying, both are going to be clubbed and then tax is going to be added. Reason, there is a particular reason for that, because we need to avoid double taxation. This is one. And second reason is that somebody else is already paying tax on behalf of you. It means that your total salary is not just your net salary that you're receiving, but also the tax that your employer has already paid on behalf of you. Okay. Now let's come to deductions from salary under section 16. So first I'm going to talk about the entertainment allowance. So entertainment allowance, this is given to the government employees. So there are three categories that are here. Okay. Whichever is the lowest from these three, you're going to get the deduction on that. For example, first one is your actual entertainment allowance that you're getting. Second is 1/5 of your salary amount. For example, if first one is actual entertainment allowance you're getting is 10,000 and the salary that you're getting is 20,000. So 1/5 of salary becomes 4,000 and C point says 5,000. So out of these three, we are going to say which is the lowest. Now, whichever one is the lowest, that is going to become your entertainment allowance. That will be your deduction. Now, everything that I have discussed about so far, is it clear to all of you? Just let me know once. Anybody from the lot, you can tell me. It's clear to all of you?
Yes, ma'am.
Okay. Let's move forward. Next, we are going to talk about the deductions. Just a minute. Deductions from salary, where we are talking. First, we've talked about entertainment allowance. Now we are going to talk about the professional tax, which comes under section 16(3). So deduction in this case, it is available in the year in which professional tax is actually paid. So if you are paying in this year, then deduction also you can claim in this year only. And if employee has paid professional tax of more than 1 year, then entire professional tax paid is allowed as deduction. If you are paying for more than 1 year, For example, advance tax also you are paying, then in that case, you will get entire amount of deduction. And if your professional tax is reimbursed by your employer, then first they are going to add to your perks. And then, like in case of all the employees, whether you're specifying or not, first you're going to add it to your perks and then you are going to claim a deduction from that. Now let's talk about the different forms of salary or the retirement benefits. The first one is your leave encashment. इसको हम leave salary भी बोलते हैं. Next we have gratuity. Then we have pension, retrenchment compensation, and provident fund. Okay, let's first come to leave encashment. So basically, leave encashment is nowhere related to your casual leave, and you are going to get this encashment for every year of service you are entitled. So be it corporate, be it government, so every year of service, you have certain amount of leaves that get accumulated and you can encash them. So you either take the leave or you can encash them while at the time of service. And if you do not encash them at the time of service, you can also take them after your retirement. Now you need to note one thing, that anything which is received by you while you are in service, it is normally taxable to all. So this rule applies to all the employees of the company. And if you take this after retirement, then you get certain amount of concessions. Now, let's talk about the leave salary that you are receiving while you are in service and while at the time of your retirement. So, if you are in service, then it is fully taxable. But there are certain exemptions here. Actual leave salary or entitled leave salary. So, basically, there is a limitation or a capping that they've made, that up to 3 lakh you can take. Okay. In case of retirement and you're a non-government, in case of government employees, what will happen? You'll get it as a full exemption. But in case of a non-government employee, even if you are there as a local authority or your corporation employee, then it is least exempt. Next, let's come to gratuity. So, gratuity is coming from the word gratuitous, and this basically means gift that you're getting. Why it is called gift is that you are getting this lump sum at the time of leaving the organization. So, but then there is a catch here that you have to be serving for at least 5 years. Okay. So, gratuity says that it means a lump sum payment made by an employer to his employees as the retrial reward for his past services when his employment is terminated. So, but one more thing is there, that your retiring benefit should be long and unblemished service. Unblemished means that you should not be under, something. I mean, there should be your employer or your manager. They should be speaking very high of you. That is what we call as unblemished services. That you've not basically involved yourself in any corrupt activities or anything like that, and you've done your work well, and therefore you are rewarded for it. So when is it payable? So this is going to be payable to any employee who is going to render continuous service for a period of not less than 5 years, as I rightly mentioned in the previous slide. And on his superannuation, on his retirement, on his resignation, or on his death. So 5 years of service is not necessary in case of death or disablement. So death, you all know, disablement is that you're unable to carry out the services of your company. Now let's talk about the basis of charge. So if gratuity is received by employee on leaving the job, then it is going to be taxable under the head income from salary. So after claiming this is exemption, you're going to get gratuity. Okay. Then next is, if gratuity is received by legal S. First is that it is received by the employee himself. Then you say it income from salary. But if it is not received by the employee himself, there is due to, deceased case of employee or his death or disablement, your legal heirs is receiving it, that for that particular person who is going to receive it, it will come as income from other sources. Okay. Because it is not salary for him. Salary it was for you. That is the employee. Next, we have gratuity for section 1010. It is received during continuation of service. If you are getting at the time of service, fully taxable. And the maximum amount of exemption that is available under this section is going to be 10 lakh. Maximum capping that they've made. 10 lakh is the maximum that you can get. Then coming to completed years of service, including period of service under current employer. So completed years of service, you're going to talk about your current employer as well as your previous employer. And if you are not getting your gratuity from the former employer, then that it is going to be included here. Now let's talk about pension. So pension is that after retirement, whatever benefits you are getting, like your monthly payments, so that is going to come under the head salary because it amounts to your salary. Because now you're not working, you have already saved for your pension, your retirement, you've already planned your retirement. So you're withdrawing some amount that is known as your salary. Next is the family pension. So after the death of a husband or wife, if it is received by the wife, then again it will come as income under other sources. Reason being the wife has not earned it. She is just benefiting from her husband's, the relationship with her husband. Next, we talk about standard deduction. If it is available, in this case, 1/3 of the family pension or 15,000. So again, a capping is made, not more than 15, and whichever is going to be lower, that is going to be taken as a deduction from family pension. Now let's talk about commuted pension. So instead of receiving the monthly pension, some portion can be accumulated and may be received. Okay, after retirement or voluntary retirement. So you all know voluntary retirement. Before your retirement is actually due and you want to retire, that is known as voluntary retirement scheme. So in this case, if I talk about government employee, who all are part of government employee, one is the central government employees, state government employees, any local authority employees, or corporation employees, any public sector undertakings, and judges of Supreme or High Court, then civil services or defense services. Now let's come to allowances. So allowances basically means any fixed monetary payments which you're getting for a specific purpose. Normally, these monetary payments are made by the businesses for their employee because they are involved in the employment process. Okay, they are involved, they are engaged with the company's work. So second point, let's read what is written on your PPT. An allowance is a fixed monetary amount paid by employer to employee for expenses that are related to office work. So expenses that are not related to office work will not form of your allowance. Okay. Allowance, they are generally included in the salary and are taxed unless they are exemption available. So you are going to make a taxation as a part of your salary unless you have certain exemption which is explicitly given to you. Now, with this, we have discussed a little about, just a moment. Yes, with this, we have actually discussed quite a lot about income under the head salary. Now, we are going to move to another head. Let me see how many students have joined. So I think the turn up is a little less today. Anyway, I'm also going to share the quiz link with all of you. Apart from that, I'm also going to share the feedback form with all of you and also the PPT with all of you. Did you all fill the the feedback form in the last lecture, the recorded lecture that was sent? Have you all filled it?
Yes, ma'am.
Okay, for this lecture also, remember that you have to fill the feedback form and you have to fill the quiz because on that basis only we will see that you have participated and therefore you qualify for the certification of this workshop. Okay, let's get back to house property. Just give me a moment, I'll quickly share my screen. Okay, I'll share my screen now. Okay. So let me quickly come to income from house property. So income from house property, it is another important head that we need to study. So house property basically means any building of which the assessee is the owner or ownership is of the assessee, be it a piece of land or a building. And it could be a home that you have made, it could be an office, it could be a shop that you have given on rent. So basically, annual value of the property will consist of any buildings or lands that you are the owner of, and therefore it is going to be chargeable to tax under head income from house properties. Now, property that is consisting of building and land appertinent thereto. So let me make you to understand the meaning of land appertinent. Because building you already understand, land appertinent means any connected thing that you have with the building. For example, any garden that is there, any garage that is made, all these will form a part of your house property. And also building will be any permanent structure which is made of brick, stones, concrete, and I've already discussed a land appertinent. It could be a kitchen garden that you've made. It could be cattle shed, garage, lawn, any car parking space that you have. All this will form a part of your land appertinent. Now let's talk about the ownership with assessee. One thing is very important, that assessee has to be owner of the property, and he need not be a registered owner, but at least he should be an owner of the property. And here we have leasehold also, and freehold rights should also be there. Now, it says that if the title of ownership of property is under dispute in court of law, then the decision as to who will be owner is going to be chargeable to income tax. So whoever is going to be the owner will be coming under the income tax bracket. And one more thing, your own property, if you're showing a rental income, you cannot use that property and show rental income. So you need to understand that as well. And then comes deemed ownership. Deemed ownership is that an individual is going to transfer for otherwise than for adequate consideration with house property. If you are normally people do this, what they do is they transfer in order to save on to their taxes. They transfer their property to their wife or the spouse or to minor child. So this should not be done. Okay, so because it shows a vested interest of the person in order to save the taxes. Now you can quickly go through the deemed ownership that is written here, talking about the inheritable assets and how house property is transferred to individual or minor child, and who is going to be the deemed owner, what is the exception. So basically exception here is that if it is a minor married daughter or unmarried both are going to come here, and the transferor who is transferring the property, and that will also come under this head. Now, what are the uses of house property? Uses of house property, where they say that assessee is using the business or this property to own and give house on rent, or it is held for stock in trade. They've made a warehouse there. So that is stock in trade where you're holding your stock. Apart from that, any property that you're acquiring in the course of money lending, then any building that you are holding as stock in trade, all this will come. Then there are income from house property which are fully exempt from tax. All these sections we need to study, and we have certain particulars that are involved. You can quickly go through this. And before the meeting ends, I'm going to take your attendance as well, okay? Just go through this, what all in which section we have, what type of property income we have, how much is self-occupied, how much is used for business or profession. Now let's come to very important part which talks about computation of gross annual value, that is income from a let out house property. So this gross annual value, if we subtract the municipal taxes, we get the net annual value. And from this, we are going to make certain deductions. One is the standard, other is the interest on borrowing capital. For example, you took some capital or you took some loan, and use of that loan you've made in order to buy a piece of land or a property that you've given on rent, then in that case, that interest on borrowing is going to be a deduction for you. And that is now how you're going to summate the income from house property. Now, meaning of this gross annual value that we discussed here is the property is deemed to be sum for which the property might reasonably expected to be let out from year to year. Okay. So any notional income is the income that you know you're going to derive, or basically the income if there was a tenant at your place. That is your notional income. So you have your fair rent, municipal valuation, whichever is higher, you're going to take that. From this, you're going to deduct your standard rent and you get your expected rent. And then from that, you're going to find out your gross annual value. Now, municipal tax or property tax you have to pay, and it has to be borne by the SSC. And it can also be claimed as a deduction, but only in respect of the let out or deemed to be let out properties. It cannot be, you cannot say in that property, you cannot use that property. And it is allowed in the year of payment only. So in the year in which you are paying the taxes, like the municipal tax, that is not going to be allowed as deduction. Then you have self-occupied house property. How do we calculate? We have GAV, which is the gross annual value. From this, we deduct our municipal taxes, get our annual value, deduct the standard deduction, income on borrowed capital, and we find the income from house property. This is what we've already studied, but just discussing. Then you have another term deemed to be let out. So if you're owner of one or more property and you're occupying more than one house of residence, then one is to be deemed to be let out. Means that you are earning rent from that, but just to save your taxes, you are not actually showing it on record. Then let out also, same way we are going to find out. Okay, so getting back to the meeting. Yeah, so now there are 58 participants, and I hope you all have joined with your names. You have renamed yourself. So I'll just quickly take your attendance also. Don't worry, I'll just take a screenshot and later on I'm going to mark you. Just give me a moment. Just stay in the meeting, okay? Don't leave the meeting so I can mark you. And post this, I'm going to give you your questionnaire. Yes, I've taken a screenshot for all of you to mark your attendance. And here only I am sharing the quiz link with all of you. You all are requested to quickly take this quiz. Okay, I'll just put it in the chat. So you're supposed to fill this Google form. And apart from this, you're also supposed to fill this feedback form before the meeting ends. Okay, quickly take in. So on the basis of you filling both these forms, I am going to, yes, I'll also share the PPT in the group, Arushi, done. I'll share it in the group. So did you all understand what was taught in the session? Students, I'm asking you. Yes, everyone. Okay. Okay. I got your replies in the chat box then. I'll share the PPT with all of you after this session, but you do not forget to give the feedback. Okay. So feedback, my name is Garishma Gulyani. Okay. You can fill in that. And also fill out the quiz. Both these forms you have to fill out mandatorily.